Cool, perfect. So, welcome everybody to the call. Like I said before, this is
Hello? Can anyone hear me?
Yeah. 1 second.
Yes, sir. We can hear you. X.
Okay. All right, cool. So the first thing that I want you guys to realize is for a lot of you, you may not have been taught what actually moves the market, right? Some of you may know that the market is being moved by, purchases, by the values of banks. But doesn't it seem like the market moves in patterns, maybe moves in waves, maybe moves in cycles? Well, that's because it does. The market moves in cycles, right? Just like the stock market moves in in an algorithm, so does the Forex market. A lot of people think that, there's just this godly entity that moves the market. Well, there kind of is. But it isn't this anonymous thing that we can't figure out what it is. So let me explain to you. Price moves in a cycle, right? And it moves between two steps. Essentially, the market accumulates or contracts, right, into a certain position, meaning that it loads up something called liquidity. It's kind of like loading a spring. I've made this analogy before and I'll make it again. When you load up a spring, what does it have? It has potential energy, right? Because that energy hasn't been used yet, right? That liquidity hasn't been expressed yet, right? So essentially, what does the market look like when you do something like this? What does this look like to you guys?
Range.
Contraction.
Right? Somebody, right? So contraction. A lot of people just said the correct answer, right? Consolidation, ranging, contraction. Sure, those are all correct answers. However, the market doesn't just stay in one position. So let me ask something, and I want you guys to answer in the chat since there's a lot of you. Go ahead and answer in the chat. Where would you rather enter the market? Would you rather enter the market when a position is loading, or when a position has already fired?
Loading.
Right.
Loading.
So usually you want you want to catch a move while it's loading, right? You don't want to catch a move when it has already been expressed, right? And the proper technical term is that the move has already been expressed. Liquidity has been expressed. So a lot of you guys may not know what liquidity actually is. And liquidity essentially is simply one thing. And to make it very, very simple, it's money, right? It's money. The market algorithm is designed for you to be knocked out of the market as many times as possible. It's meant to hit your stop loss. It's meant to calculate the means of your, or the averages of your stop losses, right? And then hit them, catch that liquidity, and then move in the contrary position, right? Now, here's a fundamental thing that you all need to keep in mind, okay? Two things. One, price is fractal, right? Who can tell me what that is?
It's the same on every time frame.
Same on every time frame. You're perfect, right?
Yeah.
Same on every time frame, meaning that the bottom time frames, the 1 minute, the 5 minute, the 3 minute, whatever, they feed into the larger time frames. They create the major time frames. They are the major time frames, just expressed a lot more individually and with a lot more detail. So it's kind of like looking into a microscope, right? It's kind of like looking through your scope, right? A lot of times in the Forex market, some people refer to people as snipers, right? When they get a good entry. Well, in this case, you want to look down your scope, meaning looking downrange, looking into your time frames, because time frame is expressed by time, right? And here that leads into the second thing. Secondly, time and price correlate. Who can give me a guess on what this means?
Correlate. I'm not even gonna say it.
Who can give me a guess? And I want you guys to either type it or raise your hand so I can call on you. Or you can just say it, honestly, it's fine.
Depending on like the certain time zone, like the market moves more.
Time zone, depending the app. Yeah, perfect. Perfect. Destiny, go ahead.
Like depending on the time that you get in a trade, like, like it.
You said correlate, right?
Yeah,
Yeah,
correlate.
like they work
DXY,
together.
like DXY and UCAT, they correlate. They follow each other. GU and UCAT, they're negative correlations.
They work together.
Work
Right.
together.
So perfect. So that's a very solid answer. So essentially, what this means is that your price, right, price and time will essentially correlate, because you shouldn't expect you shouldn't expect a euro move to really be moving a lot during Asia session, right? You shouldn't be expecting a USD pair to be moving a lot during Asia session. For the most part, a lot of different trades don't move during Asia session, but I'll get into time and price correlation a little bit later, right? So keep Asia session in mind. And a lot of you guys may not know what your time zones are. Do you guys know what your time zones are for a foreign exchange? Yeah. So just a quick reminder, right? There is Asia, which encompasses Sydney and Tokyo, right? There's London, and there is New York, right? Those are the 4 sessions of the market. Though I only have 3 really, because I mix Tokyo and Sydney for the most part. So there's a third rule to foreign exchange. Who can try to guess? Who can try to guess what the third rule is? Maybe I'm making it a little bit too broad, but well, here, I'll just give it to you, because that's a really broad question. Liquidity is king. Why do you guys think, who knows what liquidity is? Well, I just said it. So quiz time. What is liquidity? Money. It's standing money that, right. It's standing money that a bank can spare, right? It's standing money that bank can spare, meaning that that's how much money they can put into the market. And I will go a little bit more into detail with this in 1 second. So first off, we need to know that price is fractal. Again, touching up on price being fractal, it means that lower time frames essentially build the higher time frames. And when they build the higher time frames, what you need to learn is that those lower time frames are the ones that are going to get you the sniper entries. Okay? Structure, mitigation, what I'm using a little bit more advanced terms here, but liquidity voids, a lot of them, you'll learn them in the future, right? You'll learn them in the future. People who are on my team already know some of them. You will learn them, and you will know how to look for them on lower time frames and how to play them. This also goes into HFX. A lot of people don't know how to trade HFX, or they trade with indicators, or they trade like that. HFX and Forex go together. They are essentially the same thing. All that you're doing is going on lower time frames and catching lower time frame entries. That's all you're doing. It's really not that different, which is why with the strategy that I teach, you can essentially milk both. You can milk both the Forex market and the HFX market. So let's continue on, and let's talk about what time, like what actual structure looks like in a market, right? So what's a pair that I've been looking at recently? What's a pair that I have been looking at recently? I think, let me look at my personal watch list real quick, because I have a personal watch list, and let's go ahead and look at one that I've been looking for. Odd Chef is 1, the dollar is 1, GU is 1. Let me look back and try to see what these are. There's also AUD NZD. That's the one that I want to focus on. Okay, let's go ahead and focus on AUD NZD for now, because that's one that I wanted to actually focus on earlier today, and I didn't actually get a chance to. There was also the trade that I took on Euro USD, and I will run you through how I actually got that trade. This morning, I sent that signal out in both the Discord, my free channel, and the large Discord for everybody that's a member. I sent that out for you guys. I hope you guys took it. And there's also Euro JPY that I took. So we're going to look at 3 different trades where I actually show you how price is fractal, and I'm going to prove to you how price is fractal. So as you guys obviously see right here, my TP got hit for about 81 pips, right? It went as low as, let's see, from my entry, it went as low as 100 pips, right? So you could have potentially caught 100 pips in this trade. Now, let me tell you how I did this. Oh, and if you're trading HFX, you could have abused these contracts, because all of these are on 3-minute time frames. You could have gone, say, like, you know, a couple minute here, a couple minute contract here, a couple minute contract here, a couple minute contract there, and you would have milked the market on one single move. And let me prove to you how price is fractal and how time and price correlate. Okay, so let's go up to the daily. This is your JPY, my fault. I am talking about your USD, my fault. Yeah, so right here, same thing. My final TP got hit for 90 pips, but let me prove to you again. Let's go over here. Cool. So a lot of people use different structures in the market, which is completely fine. But what I like to use is I like to use a strategy called Wyckoff. And a lot of people don't know what this is. A lot of people have read on it and they don't really do much research into it. But essentially what it is you end up taking the market by its phases, right? So the market has 2 phases. For all of you guys that have been with me before, you guys would know this. The one phase, right, is contraction, and then the second phase is expansion. Contraction is a phase of consolidation, right? It's a phase where the market consolidates and kind of just staggers for a little bit. And that is knowing how to spot your different phases of accumulation or different variations of accumulation will help you in the future, because you will end up knowing exactly how to look at the market and know the direction that the next expansion is coming from, right? Or the expressing of the move of the liquidity, right? The only thing that expressing liquidity means is that the market moves very fast, very quick, right? Or that it moves in an impulse like this, right? That is expressing liquidity. This is expressing liquidity. This is expressing liquidity, right? And I will go a little bit more into depth on that in 1 second. So let's go to the 4-hour time frame. Now, in the 4-hour time frame, we see something pretty nice, right? So first off, we see the fact that the market itself actually makes a very similar structure, and there are different phases to this thing called Wyckoff, right? Essentially, what it does is it has 2 different variations of consolidation. And let's go back to the whiteboard to actually take a look at this. The first variation of Wyckoff schematics essentially is this. It is distribution and accumulation. There are 2, and I'll show the first off. I will show accumulation. Okay, and the funny thing is that you see these on all time frames. So take it how you may, but you may already be ahead of the curve if you're looking for these on lower time frames and using higher time frame structure as confluence. Confluence just means confirmation, right? So let's keep going, and let's say that the market comes from a downtrend, right? And then it starts doing this. Creates a trading range of consolidation. It does something like this, right? So essentially what you want to establish first off when you are trading, you know, this Wyckoff schematic is essentially you want to establish that you have a trading range, right? So usually you won't see a schematic until it has at least formed a shakeout, right? Which is what it's called, a shakeout. So in this specific formation, right, in this specific variation, you have right here, you have your trading range. Let's highlight that. You have your trading range or trading zone, however you want to call it, your trading zone, right? So in this case, it respects these this zone, and I'll show you how it does this. So first off, the first point right here is something called the PS, preliminary supply or support, right? Up here is something called the automatic rally. And I'll teach you guys why these are so important in just 1 second. And then right here is called the ST, or the secondary test. The ST, or secondary test, is extremely important. And I'll explain to you why in just 1 moment. Right now, this right here is just respecting the trading range. So this right here, this last hit, basically establishes trading range. So at that point, you know you're in consolidation, And you know you're looking for certain characteristics of this consolidation so that you can end up trading it. And a lot of times, a lot of retail traders will be taught that you should not be trading consolidation, right? And that's fine. That's your opinion. But I would rather catch the move while it's loading right here or right here rather than having to wait until you get a million confirmations from 70 different indicators and you end up buying up here, right? Or you end up buying up here and you're in drawdown, right? So to me, I think that catching the move before it even expresses itself, I think is a lot better. Wouldn't you guys agree? So let's go down here and let me show you guys what this is. This right here is known as the spring or the shakeout. The spring or the shakeout. And now this spring or shakeout, right, will end up being the thing that determines whether or not your accumulation schematic is actually a true accumulation schematic, right? If it's a true accumulation schematic, the next piece of the puzzle will fit in perfectly. And you can catch this preemptively if you want to be a little bit more of an aggressive trader, or you can catch it afterward, whichever one works, right? Whichever one works. So in this case, what ended up happening is we have the spring, right, or the shakeout, and next we have the test. And this test is extremely important because of the fact that you as a trader have to be watching for these constantly, both on lower time frames and on higher time frames. They're not all going to look exactly like this, but you have to learn how to identify market structure in a very choppy situation, right? The one thing that they teach you in the classroom doesn't always exactly match what you see in the field. Same thing applies here. You won't always see the market. You won't always see this completely come like right here so it could fit a trend line, right? No, sometimes it'll come down to equal lows, right? But as long as structure is not broken, you hold. Structure holds, you hold. Let me actually make this giant for you guys. Structure holds, you hold. Okay, it doesn't matter what you may be thinking, but what you need to do is if structure holds, you hold. There is no reason for you to fold a trade if structure has not been broken, even if you're in a little bit of drawdown. And for my team, for people that I've taught before, they don't get much drawdown. They get 4 pips, 5 pips, maybe 6 pips, sometimes 10 or 12 pips. Those are considered a little bit larger stop losses for me. So now we have the test. And this right here, this touch of the trading range right here is called the backup, right? Or a lot of people know it as, well, actually, no. Yeah, that is the backup. Right, and this backup essentially is simply a move back up to actually test the trading range. See, actually, this should be a little bit higher up, so that it can actually test the sign of strength. It's also known as the sign of strength, or SOS. And this is meant to actually test the range above, so that banks can actually tell, hey, are we actually strong enough to break this? Like, are we strong enough to completely outweigh retail traders to actually come above this trading range and take all of their money? A lot of times, since they know that a lot of traders use support and resistance, and they put buy stops or sell stops beneath support and resistance, quote unquote. And if you guys still use support and resistance, I'm sorry to break it to you, but it's a myth. Support and resistance is a myth, because a lot of times what banks will do is they will tap that trend line, or they'll go just a little bit above. They'll literally do this. They'll go just above it and then come back up. Right here, they just triggered thousands, maybe millions of buy stops, right? They already triggered them. They're in profit for 2 seconds. These are the guys that DM you and tell you, oh, I'll manage your account and I'll give you good profit. Those are the guys that just got absolutely destroyed, right? Those are the guys that just got their buy stops taken out, right? And their stop losses are all the way back here, right? Because they believe in the 50% retracement. So what they're going to do is they're going to put their buy stops, or the order. Do you guys know what buy stops are, by the way? Just so I know that I'm making sense. Everybody know what buy stops are? So essentially, no, buy stops are not stop losses. So buy stops, let's say you put a buy stop right here, right? Price will come up to it and activate it as soon as it crosses it, right? Unlike a buy limit where you have your limit, price goes down to it, touches it, and then goes your way, right? So they're two different things. So essentially right here, they have orders that will activate as soon as price crosses the quote unquote resistance, right? Quote unquote. So what will happen is they just got tapped in, their stop losses get absolutely stopped out, right? So they have to go tell their investors how they just lost their whole account in 2 minutes, right? And then from there, you as a Wyckoff trader, you will know, okay, well, I expected this retracement. Cool. I'm in from right here. I'm in from right here. My stop loss is back here. My entry is right here. Perfect. But if you want an even lower drawdown entry, you could have gone to your lower time frames and gotten this right here and gotten it on the return. Because remember how I told you guys how price is fractal? Remember how I told you guys how price is fractal? Well, what makes you think that price here won't actually return, won't actually do the same thing that it just did here, but right here? If you zoomed in right here, what tells you that price wouldn't do an accumulation schematic on a lower time frame? What tells you that? Have you ever wondered that? Have you ever backtested it? Backtest it. You'll see. And you will learn to see that even on the 1 minute time frame, you will see a little bit of consolidation there that will give you an entry. And I'll show you how to do that later. Actually, no, I won't. That's too advanced for this class. So essentially, we have this test, right? And then afterward, we have the sign of strength. Now, here is where a lot of people want to get in. You know, a little bit more new Wyckoff traders. They want to get in right here. That's completely fine. You can get in right there. You know, you catch some type of structure within the middle. You fill your liquidity voids. You hit your rally-based rallies, whatever, and then you end up getting into the trade. That is completely fine. But a lot of the times what ends up, you know, messing a lot of people up is that they don't expect the deep retrace, meaning that they don't expect price to maybe not form like, you know, like the angel that they think it is, and they'll expect it to hit exactly right there. They'll over leverage, put a small stop loss, and wonder why they're not getting results. Well, because price hasn't told them, fractally hasn't told them to get in yet. Right? Price hasn't told them to get in yet. If on the lower time frames you don't see something similar to this accumulation schematic, you will not be able to get into that market and be profitable. Okay? Because of the fact that you have not considered the first rule of trading. What is the first rule?
Price is fractal.
Price is fractal. What is the second? What is the third rule, actually?
Liquidity is king.
Liquidity is king. How can you mix these two in this position? How can you use these two concepts together?
Spot the same price action in the lower time frame, and abuse the what do you call it, kill zone or order blocks.
Right.
Make sure it fills the liquidity void. And,
right. Perfect.
Yeah.
Yeah. Perfect. So what happens a lot of the time is that people don't end up realizing that since price is fractal, that means that if the lower time frames don't tell you, hey, you can get in now, meaning you don't see one of these or you don't see its sister, which I will show later, right? You won't be able to get into this market. If bullish structure is not holding on this downtrend, meaning that lower time frame structure has not shown any indication of going bullish, should you be buying yet? No, there's no reason for you to. There's absolutely no reason, and it's borderline silly to be buying at that point. Okay, so now that you know why price is fractal, right? At every single one of these points, you will get a sign of reversal from the market before it actually comes back down. So since price is fractal, I swear to you, you need to make sure that you are on the lower time frames trying to spot these schematics, right? Now the backup or the sign of strength, right, will end up pushing you up and triggering liquidity, which means that if it actually triggers liquidity, meaning it just stopped out a ton of traders. A ton of these quote unquote breakout traders, trading gurus, people that don't know how to trade. What just happened? Their limit or their orders that just that activate as soon as price crosses that line just got activated and stopped out at the same moment. What do you think happened right here? What do you guys think happened right here as well? And right here to those same traders? I'll give you a little hint. What do you guys think happened? Come on, T. Oh, wait, actually, let other people answer, because I'm pretty sure you know the answer. I'm pretty sure you know the answer, bro. So I'm seeing some mixed answers. Tried to sell, got stopped out. Yeah, perfect. Actually, yes. So essentially, let me show you what. So think of it like a retail trader. Trade against yourself in this case, right? The biggest enemy in this market is going to be yourself. And that sounds cheesy, but it's true. Why? Because you need to trade against your retail self. And what does retail mean? Retail just means that everybody that can't really trade. Looks like a breakout and retest. Perfect answer. This looks like a breakout in a retest. But people say, oh, no confirmation, no entry. Well, what is your confirmation exactly for it to hit your trend line and then it's selling? Is that your confirmation? Is your confirmation looking on lower time frames and trying to find fractal price action? Because a lot of times, unless the candle is closed, right, the candle won't just stay in one position. It'll do this, right? It'll look like this 1 second, then it'll look like that the other, and then 2 seconds later it'll look like this, right? And this may be confirmation for you guys to be selling. For a lot of retail traders, this little candle, when the candle hasn't even closed, right, this is just a few seconds apart, it'll look like this same candle is now going to sell off. And what ends up happening? It ends up just being a wick down and the market shoots all the way up. And people get frustrated and then they just blew their account, right? So let's look at this one more time. This looks like a break and retest. Not only that, so people just got stopped out here. But people also got stopped out here. Who can tell me why people got stopped out there? Who can tell me why people got stopped out over here? So get your answers. Thought it was going to bounce, go up like the previous. Perfect. Perfect. So they thought that because this range was established, they thought that that they should, go ahead and abuse the market like the market guru they are and try to buy here. They just got taken out. And let's say people did know a little bit of schematics, but they didn't know it completely, or say they were taught how to breakout trade, right? What were they going to say? Oh, well, maybe I should buy. Maybe I should buy. Maybe I should buy around this area. Guess what? Weak sellers just got stopped out again. Because a lot of times these reversals look like this on lower time frame. So this is the bullish candle, right? And right after they see a bearish candle. They look like that. Boom, boom. It looks like it happened in an instant. And people will be like, oh my goodness, I was in profit 1 minute and then the next it was gone. There's a reason for that. There's a saying in the market that says, your stop loss is my entry. And that's perfect because a lot of people that don't exactly know how to trade or haven't been taught correctly will end up using large stop losses and they'll end up getting in the middle of a trading range with no confirmation at all, just because somebody sent them a signal. My objective is to teach you guys how to not be taking signals and you being your own signal, right? So what ends up happening? We have 1, 2, 3, and 4 positions where liquidity is king and the banks have just stopped out thousands of traders and they have now received that liquidity for them to put into the market. What does that mean? Well, the basic laws of supply and demand essentially state that for every buyer, there has to be, for a price to buy, somebody has to be selling. So write this down, and this comes straight from finance, right? This comes straight from finance. So this is actually the fourth unspoken rule, and people will criticize you if you speak about supply and demand in professional trading rings. But at the end of the day, it's very true, because this is the market price movement theory. So essentially, supply and demand laws hold for volume. And I'll explain what I mean by this. Supply and demand laws hold by volume, essentially saying that there is a hierarchy of price, right? You as a trader, as a retail trader, we're at the bottom of the pyramid. We're at the bottom of the pyramid. We're at the bottom here, right? This is where all us retail people are. Are there more of us? Obviously, right? There are much more of us. There are thousands, probably millions of traders in the world. Do all of them know what they're doing? No. That's why, in statistics, it says that only about 92% of people who actually trade foreign exchange will fail. But that other 8% will succeed, and they'll succeed massively. Why? Because they know how to trade something like this. They'll follow these rules, right? And after that comes in, small banks. Actually, why am I even drawing that? I should just type it out. So small banks, right? And what do you guys think these small banks actually do? These small banks are also involved in trading. So they're also going to be trading sometimes even retail strategies. Many of them may not even have professional traders on their ranks. Afterwards, there's going to be, small banks and brokers. Then after that, there's going to be large equity investors, or just put large equity, right? And who can tell me what large equity is?
Big capital.
Big capital. So essentially millionaires, billionaires, people that have large investment companies, people that want to quote unquote expand their wealth, and they want to make a lot more money. Those people a lot of times don't even hire big firms. They don't hire big firms like Goldman Sachs and stuff like that, because of the fact that they're going to be charged so much by first, taxes, then by the firm itself, blah 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 blah. They're lazy. They don't want to. So what do? They look on it on Instagram or on different social medias, and they're like, okay, I want you to trade my account. And for what? They've never seen a track record. They've never seen anything. But that's the unfortunate truth of the market. That is what large equity investors do a lot of the times. After that comes in the big banks. And why do you guys think that I mentioned the big banks here? And of course, around everything, what controls everything is the market algorithm, right? But we'll go into that a later class. So the big banks have the most weight. The Forex market essentially is moved by the biggest weights, right? So a lot of times you'll hear like, oh, that's a heavyweight investor, or oh, that's a heavyweight pair, or whatever, right? They essentially say that because that position, right, or that entity in the market holds a lot of weight. So essentially what that means is that they have a lot of money. They have a lot of liquidity. But say if somebody were to give you a discount, right, or would be selling it to you for a discount, right? If somebody would be selling to you for a discount, when you get something, right, when you buy something, what do you want to buy it at? A discount or premium price?
Premium.
Discount.
You want to buy it at premium?
Let's go.
Right, you want to buy it at discount. What does discount mean to you?
Saving money.
Saving money. By the way, does my mic sound okay?
The lowest price.
It's pretty good.
Okay, let me know, because somebody just said that I sounded like an automated voice message. So essentially, right, when people when you want to buy something very expensive, right, because keep in mind, banks are trading in the millions of lots. A lot of you guys may not have even seen 50 lots, 100 lots. Now imagine your trading view or your MetaTrader showing millions of lots. A lot of you may not have seen that. You know what's funny? A lot of traders do it. Bank traders do it. So now imagine having so much weight on your shoulders that you can actually move the market just by getting in. But just by getting in. So what are you going to do? You as a big bank trader, what you're going to do is you're going to say, I'm going to try to buy it as low as I possibly can. So for as little money as possible. Now let's go back to the laws of supply and demand that hold for volume. For every buyer, there has to be a seller. For every buyer, there has to be a seller. What if you manipulated price enough to knock out more sellers in the market? What if there was, let's say, 900 sellers, right? And let's pretend that we're in this position, like right from here to there, right? We're like right around here is where price is, right? Let's forget about this. This is where price is, right? There's 900 sellers at this point in time, and let me highlight it for you guys. So at this point in time, there is 900 sellers and only about 300 buyers. Now you see why the market has sold off, right? It's sold for a little bit. Why? Because there are more sellers than buyers, obviously, right? The selling weight is a lot heavier than the buying weight. Now, let's say you as a bank, you jump in on your sellers, right? You jump in. So now there's only like 100 buyers and 1,200, actually, no, sorry. Yeah, 1,100 sellers, right? What's going to happen? A lot of buyers are going to get knocked out of the market, right? Now this is when you get in, right? This is when you get in. People just took profit. A lot of sellers, right, that try to break and retest type thing, right? Or try breakout trading. What are they going to do? More sellers are going to get stacked into the market. So now what are you going to do? You're going to move price a little bit up, hit their stop loss, and this is where you start pumping entries, right? You start pumping entries. You start popping 100 million lots, 200 million lots, 500 million lots, 600 million lots, 900 million lots, right? When you start doing this, price is going to skyrocket. Why? Because these sellers just got knocked out of the market. These sellers just got knocked out of the market. So now these sellers no longer exist. They're not there anymore, right? So even if you had, what?
Your mics must know.
Okay. Is that better?
Yeah, probably.
Yeah.
That's better?
Yeah, you start.
Okay. So let's say that now these sellers are completely gone, right? These sellers are completely gone. So now you only have about 200 sellers. And now you as the bank trader, right, you've been saving up liquidity. You've been saving up money from all these people that got their stop losses hit. And what are you doing? All of their sell positions just became your buy positions, right? So again, supply and demand, right? For some sell, like for price to buy, somebody has to sell, right? So what are you going to do as a market maker for you not to accidentally crash price? You obviously need to put in sell orders here. Are they going to be in massive drawdown? Yes, but that doesn't mean that you have to put as high of a lot size. So a lot of banks, what they'll end up doing is they'll end up hedging their positions. And the game of trading, and I'll drop this nugget for all of you, even though I was saving it for my private class, but the market runs in a cycle. And the game of trading is essentially catching liquidity and banks closing out their own orders. Banks will close out their own orders, okay? Or they will mitigate losses. Meaning, let's say you have an order right here, right, from the bank. You have an order right here of about 200 million lots selling, right? You have 200 million lots selling. Now, you move up with 3 orders, so 3 times 800 million lots. Because of the fact that you just took out so many sellers that you can now afford this price because you just bought it at a discount. Now, how can you spot discount in a chart? Essentially, this impulse move, right, has a level of about a 50%, right? So around this area is where the 50% is. Anywhere above that 50% is known as premium. Anywhere below this 50% is known as discount. You will hear this a lot. Pay attention to it. You should only be buying in discount, and you should only be selling in premium. Why does that make sense? Because of the fact that you want to sell at a higher price, don't you? Because you get more return, correct? And you want to buy at a discount because of the fact that you, as a trader, want to buy the market as the cheapest or lowest price so that you have more liquidity or space for, you know, the market to actually shoot back up. Okay? Let's get rid of this. Oh, whoops, I just deleted test. Can I get rid of this without deleting test? No. Well, whatever. Let's just leave it. So essentially, going back to the point, these 200 sellers can do nothing against your lots, right? They can do nothing. So what are they going to do? They're going to try to buy with you. Fine. That's completely fine. But now that they're buying with you, you're buying at, you could say, higher prices, right? So you're not going to get as much profit as you possibly can. So what are you going to do? This 200 million lot selling is preventing the market from completely skyrocketing up in one candle, right? This is what prevents the market from crashing, right? Now, let's say you as a trader, as a bank trader, want to create a massive impulse move. So you want TP to be all the way up here in the sky, right? You want TP to be all the way up here. But how are you going to get here from day 1 to day 3? Let's say you want to take 3 days to do it, from day 1 to day 3. And like I said, what is the second law of trading?
Price correlates.
Price correlates with what?
Time.
Time. Price correlates with time, right? And like somebody just said, absolutely, right? Absolutely. What somebody just said. Buy at wholesale and sell at retail. That's a pretty good answer. So let's say you want to move price in in a very strong amount of time, in a very short amount of time, right? What are you gonna do? You're gonna reduce these 200 million lots to say 100 million lots or 50 million lots. And these are just estimated numbers, but banks do trade in the millions. That is something that you're taught. So let's say you go to 5 million lots, sorry, 50 million lots, right? And now these 50 million lots just crossed out this 200 million lots. So how are you going to reduce the number here while not taking as large of a loss? Where are you going to push the market? And your entry was right here for the 200 million lots. You're going to go back and get closer to entry, right? Which is why price returns here. Because banks want price to return closer to their entry. Not all the way to their entry. Sometimes they do go all the way to their entry, which is what scares off a lot of other traders, because they just collected even more liquidity right here, right? On this quote unquote support and resistance, right? They just hit breakout traders one more time. They just added insult to injury, right? And they just smacked them again. Give me your money. Okay. So what ends up happening? Price has to return closer to their entry where they put this 200 million lots and has to mitigate losses. It has to mitigate losses. Now, essentially, when these losses become mitigated is right at this point, right? And this is where they can reduce or close out these 150 million lots, so they only leave 50 million lots. And now they're buying it at discount, right? Again. They're buying it at discount again, and not only that, they're buying it a lot more strongly because they just added 150 million lots. Where did I get this 150 million lots? From the ones that they closed right here. From the ones that they mitigated their losses from. They just added, they closed out their sell positions and added buy positions. Your stop loss is my entry. Okay, that's what the banks are going to do. And what ends up happening? Boom. Right, the creek is jumped right here. That's a Wyckoff term. This right here, this big impulse is called the jumping the creek. Now, some people are going to make fun of it because some people know who ICT is and they know that he makes fun of Wyckoff all the time. But essentially, the market fundamentals are never going to change. So now that you know, right, how to look at accumulation, does everybody understand how accumulation works now? Does this make sense?
Yep.
Yeah.
What about all the people in the back? I would rather you stop me now and tell me to explain something again.
This is perfect.
Explain it one more time, please.
Okay, so essentially, I'm just going to explain Wyckoff, like the schematic. I'm not going to go back and explain all of this because all of this was a ton of talking. So essentially, what you wanna find, right, is consolidation that has a couple characteristics. First off, you want it to have a shakeout, right? Meaning that you establish a trading range, right? You have your preliminary support. You have an automatic rally, meaning that it retraces, right? And then that retracement doesn't break equal lows. Sometimes it can break equal lows a little bit, but be lenient with it. Obviously, be smart. You don't want to be predicting price until you've seen at least this phase, right? Until you see at least this test, you don't want to be calling it accumulation, okay? So you have this preliminary support, or sorry, yeah, support, and then you have this automatic rally, right? You have this secondary test that essentially essentially begins consolidation, right? Then this push back up establishes trading range. It establishes trading range so that you as a trader can look at this and say, okay, consolidation may be starting. Now, this is where a lot of people are going to end up selling because they said, oh, it actually made a new low, blah, blah, blah. Let's sell on a retest. This retest just got absolutely destroyed, right? Now, this spring and shakeout essentially breaks through the bottom, right, of the trading range and will immediately come back up. Once you see something like this, then you should be saying, okay, I see a spring or a possible spring. Don't say a spring, a possible spring, right? And now you await either a tap of this and a return to structure. Now, here is something that you will need to get down pat. For accumulation to be accumulation, it must hold bullish structure, meaning that it cannot break through this low. If it breaks through this low, this is something that some people call it fake accumulation, or it's just not accumulation, right? It is not accumulation if it breaks through this low. Can it go to this low? Like, can it visit the low? Yes. It cannot break through it. Okay? And now from here, you end up bouncing up, right, and going up to the sign of strength. If you do not have the sign of strength and you still bought here and it just kind of went like this and like it ended up falling below this previous high, right? If it ended up falling below this previous high, you want to get out and start looking for a selling opportunity because that's something known as fake accumulation or redistribution, right? Whatever you want to call it, but essentially the same thing. You need to have the sign of strength for you to stay in this trade. Because at this point, you can buy it right here, just based off of, you know, your 79 optimal trade entry, and I'll explain that later. And then from there, it'll bounce back up to the to the top of the trading range. You need this to stay in the trade, and this will be extremely important for you guys on lower time frames trying to trade HFX with this. Why? Because if it doesn't actually break this high, it's no longer accumulation, right? Because it actually never showed a sign of strength. It never showed that it was willing to move up. Okay? And now this sign of strength is going to drop back up and test the test. Testing the test can be a little bit difficult because sometimes you might see a wick a little bit above it, like a little bit like right here, right? Sometimes you'll see that, but that's a little bit more advanced. You usually want to hold bullish structure, right? As long as you hold bullish structure, this continues to be accumulation. So make sure that it never breaks past its low, right? Now, once it hasn't broken past its low, you buy up here again, right? You already have one entry here. You put in your second entry, and then boom, you ride the wave up, right? And that wave up will essentially be accentuated by this jump of the creek, right? And a drop below, a drop back to quote unquote retest, but really is just reaccumulation, right? And that reaccumulation that you'll see right here will end up shooting your price back up. So if you look on lower time frames right around here, you will see an accumulation schematic and it will shoot your trade back up. So essentially you have 3 positions that you can get in, which is 1, 2, and 3, all as long as you hold bullish structure and you learn to see how your Wyckoff schematic actually is produced. Okay.
Hey, James.
Yeah.
Can you have more than one secondary test?
Yes.
Okay.
Yes, you can. So you can have more than one secondary test. You can have many secondary tests, right? But as long as it doesn't make that spring, it's not accumulation yet. Okay. And what time frame are we looking for in all of this? You, as I said in the beginning of class, you can find this up to the 1 minute time frame, the 30-second time frame.
Quick question. You said that wait, what'd you say? You said that, sorry, I'm trying to find it in my notes.
Go ahead.
For it to be accumulation, it has to be bearish, correct?
No. So for it to be accumulation, it just has to be a trading range, right? That actually has a shakeout and holds bullish structure on both the test and testing the test, right?
Okay, gotcha.
Accumulation is this whole schematic that I just showed you. It's a phase in the market. It's a type of accumulation that will tell you where the market's going to go. It's a phase in the market. And the cool thing about this is that you can find these on lower time frames, right? Since you can find these on the 1 minute, and I'll go straight to an example right after I explain distribution, right? And can you explain holding bullish structure? Yeah. So holding bullish structure essentially is you have your shakeout right here, your spring. The test has to make a higher high. Sorry, a higher low, essentially. It has to make a higher low. It can't drop below it, because then that's no longer bullish structure. It has to at least hold the middle, like the low. It has to hold the low for it to be considered bullish structure. You can't have it break beneath and still consider that bullish structure. That's nonsense, right? So you essentially want to make sure that it stays above this point right here. Right? Now the cool thing is that you can find these on any time frame, as low as the 1 minute, as low as the 30-second, whatever you want, because the market moves in cycles, and the market can't move from point A to point B without having a buyer or a seller. Like I said, the laws of supply and demand hold for volume. Meaning what? Meaning that the laws of supply and demand, meaning that you have one seller and one buyer, the transaction is not immediate because you are dealing with millions and millions of people all over the world trading it. Right? Not all of them can press sell at the same moment or buy at the same moment. So obviously on lower time frames, you're going to have these schematics because then you see the transfer of power between the bulls and the bears, right? So this is accumulation. And if you guys want, you guys can take a screenshot of this. And TJ, can you do me a favor, or Giselle, can you guys do me a favor, screenshot this and put this in the chat, please? So now that everybody has this, I am going to go into distribution, which is the sister of accumulation. Distribution can also be found on lower time frames, okay? Essentially, it is a trading range, right? Usually it's found after an uptrend, usually, because reaccumulation and redistribution also exist, but I'll explain those later. So it ends up coming up here, right? It ends up doing something like this. Okay, now I'll explain these. These phases, so usually distribution wants to hold a trading range. That's theoretically. Most times it doesn't. Most times you'll see it kind of like a natural curve to it, like this. Kind of looks like a mountain, right? Usually you will see it curve like this. A lot of times you won't see it actually establish a trading range, but for you know, for purposes sake, let's pretend that this is a trading zone, right? Like, so from, well, actually, let's not even go into the trading zone. Usually what you want to do is you want to make sure that these lows get broken, right? And your trading zone right here, right, gets broken by this thing called the upthrust. And I will go into the phases now. So this is now is your preliminary supply, so your PS or PSY. Right, this right here becomes, actually, let me make sure that this thing doesn't like get deleted in the future. PSY, this is, again, who can guess what this one is? You saw it on accumulation.
Automatic rally.
Automatic rally, the AR, right? Automatic rally, and what is this position up here?
Secondary test.
Secondary test. So this secondary test ends up getting tested right here, right? Now you have a lower, and this is one thing that I do want to point out to you guys, is you do have a lower trading range. And this lower trading range is essentially what you want to focus on. I drew this a little bit sloppily, but pretend this goes right here, and then, you know, let me actually redraw this line. This looks kind of sloppy. So let's say,
Hey, James.
yeah.
So the secondary test can be higher than the buying climax?
It has to be higher than the buying climax most of the time.
Okay.
Essentially, this is what it looks like. A lot of times you will see this get broken and mitigation up here, right up here, and this goes into my market extremes theory, which I've taught my my direct downlines. But so essentially, you have your PSY, your preliminary supply, automatic rally, support. Secondary test, and now you have this kind of loading, like you have this little loading position right here. A lot of times this one actually reach the the AR, it will actually just fall short and then continue up, probably because there's some structure here or whatever, and from there it'll shoot up into an up thrust, right? And this up thrust will end up becoming your oh, actually no, I did draw that right. Okay, yeah, let me do it like this, because there's two variations to this schematic, and I'll explain it in 1 second. So here you have the up thrust. In a lot of different schematics, the up thrust will look something like this, okay? So you have your PSY, you have your AR, you have your ST, right? You come back up, and then you have one like that, and then it'll come back down, and it'll go higher. And then it'll mitigate itself, and then it'll come back down. Okay, so let me explain to you why the trading range, why the upthrust is so important. So this upthrust essentially shows the market how strong it actually is, right? Because it shows that it can push traders forward, right? Again, liquidity is king, right? So off of this quote unquote resistance, right? And oh, actually going back to that question, does the PSY have to be, does the ST have to be higher than the PSY? Sometimes it'll be at the same level, creating a support, or sorry, a resistance, quote unquote, right? A fake resistance. Because we don't use resistance, do we? No, we don't. We don't trade with such retail things, right? So what do? This ST, right? A lot of people will have what above it?
Stop loss.
They'll have stop loss for sells, right? They'll have stop loss for sells because they're trading support and resistance, right? They'll have stop loss for sells. They will have what else? What will people have above it?
I would say a sell limit.
A sell limit, a buy stop maybe?
Yeah, buy stop. Yeah.
Buy stops, right? Buy stops will actually be held there, right? And these buy stops get triggered and their stop losses just got taken out right here, right? Now, institutional traders will know that this position right here may be an order block, maybe a liquidity void, right? Whatever it may be, it actually will get hit and you will be in profit, right? And you'll hit your take profit for the buy. However, this up thrust, right, essentially is meant to shake the market so that weak sellers get out, meaning people that trade support and resistance get out of the market, and it'll start shooting up, right? I'll be like, oh, thank God for stop loss. It just saved me from like my account getting blown. What you don't know is that the market gave you so many entries for a buy down here. You just got in late because you don't exactly trade the way that banks do. A lot of times waiting for too many confirmations will end up killing you, especially if your confirmations come from indicators. if you're trading break and retest, if you're trading supply and demand, support and resistance, you won't know when to enter because the market has already given you ample entries all the way down here, not up here, right? They're not giving you an entry up here. There is no buy signal here. The buy signal was down here, right? So what ends up happening is late retail ends up coming in, meaning late people that want to buy late end up getting in there and profit 20 pips, and then their stop loss of 50, 70 pips gets smacked, right? How many times have we seen it happen? Now, this actual push up or the thrust up to mitigate this high is called the up thrust after distribution, or UTAD.
Wait, so when they enter the trade, how long would they hold the trade for?
For when?
For like when you say they enter at the bottom, how long would they hold the trade? Like for like, is it hours or days?
Well, like I said, what was the first rule? What was the subliminal? What was the total rule of trading? If what holds, you do what?
We're gonna go with
If structure holds, you hold.
If structure holds, you hold, right? And did structure break here? Did bullish structure break here? No.
Nah,
So if
still
you
going
were
up.
in that buy, right? If you were in that buy, you hold that buy until essentially you see some type of distribution schematic, which you would have seen a little one here on lower time frames, and that would have been your cue to get out.
Okay, okay.
That would have been your cue to get out. So, but let's not focus on that. I'll show you an example of how to trade that a little bit later, okay? I'll
Okay.
show you a live example that I actually took today, okay? So now we have this up thrust after distribution. This up thrust after distribution is very important because it needs to be mitigated at some point. Why? Because this is something known as open liquidity, right? And that open liquidity essentially ends up being what banks are going to target so that they can mitigate their losses. Obviously, because they just entered, you know, a lot of lots for a buy for price to move up. Remember our supply and demand laws. For buyers, there needs to be sellers, right? So what ends up happening? You end up needing to have a lot of buyers for price to actually buy, but you also need to have sellers, meaning that these sells right here, right, ended up getting mitigated once this came back down, right? It ended up reaching it. Now, some people will say, oh, this looks like a head and shoulders. Okay, still kind of retail, but let's go ahead and try and see if this is a head and shoulders. You're in profit 40 pips. It retraces, hits your stop loss. Okay, this is meant to happen to take out people that trade harmonics, that people that trade, you know, retail patterns, falling wedges, rising triangles, whatever, the 9-star kung fu, whatever the hell, right? They're not involved in their plans for the banks, right? And what are they going to do? They know that Wyckoff isn't widely taught. They know that they can't do anything about Wyckoff. They can't do anything about smart money. Why? Because the market moves in an algorithm, which means that no matter how much money you have, you cannot prevent these schematics from forming. Okay? So let's go back to our formation. So we have preliminary supply, automatic rally, secondary test, the up thrust, which breaks the trading range and takes liquidity, right? Coming back down, which also takes liquidity, right? And then we have the up thrust after distribution. Now this up thrust after distribution, what do you think follows this? And this was also present in accumulation.
The spring.
This is the spring.
Oh, that's the spring. The test.
Yeah. The test. So the UTAD essentially becomes the spring of distribution. The UTAD is essentially the spring of distribution because it shakes
Yeah,
weak.
makes sense.
It shakes
shake
weak
out.
sellers out, right? And it's essentially you shake out. So after that, we have the test. What do you guys think comes here?
Last point of supply.
Last point of supply. And this last point of supply, essentially, like we said, going back to our supply and demand rules, right? This last point of supply will essentially tell you how strong the market actually is. And it will end up showing you whether or not the market can actually break the low and come back up. So usually this low, so a lot of times what will end up happening is this low doesn't get broken to shake people out. And what will end up happening, it'll actually come back up, test the test, or test the, no, it will usually test the test, right? It'll wick up to test the test, and this is your entry right here. It'll wick it, your stop loss right above it. That's maybe 3-4 pips, right? Today I took a 4 pip stop loss and entry, and then it'll start doing this, and it'll just dump. And I'll show you an example in a few seconds, right? This essentially, this test, again, this test of the test needs to happen because there's still liquidity over here. There's still entries that the banks want to mitigate. The banks want to mitigate their losses, right? Because they just put in a ton of lots for buys, a ton of lots for buys, a ton of lots for buys. So what happens if they push the market, if they take a little bit of profit from their selling positions, now there's more buyers than sellers for a short amount of time, they end up hitting their test again, right? They close out a lot of their buy positions and leave a couple positions, obviously, because of the law of supply and demand, right? There has to be a buyer for every seller, right? What ends up happening? All of their buy entries that they just closed out, they just put in more seller positions. So now price is going to plummet. Okay, perfect. So now, do you guys understand distribution?
So is it always, so do we always wait for that retest of the test?
Do you always wait for that test of the test? Yeah.
The retest?
Yeah, usually you can enter either at the test and you'll be fine, but if you try to enter at the LPSY, wait for that retest and then get and enter there. You can also enter at the LPSY, you just need to monitor your entry a lot more. That makes sense?
Yes, thank you.
So is it like so accumulation, you looking for that for a buy, and then distribution overall, you looking for that for a sell?
Can you repeat that one more time? I didn't hear you.
You said something. Can you hear me now?
Yeah.
Okay, so is it that you look for accumulation with the buy and distribution with the sell?
Yes, ma'am. Essentially.
Okay.
Yeah. But remember, these can happen in both a downtrend and an uptrend. You just want to make sure. So accumulation is most likely to happen after a downward thrust, right, or a downward expansion, while while distribution is more likely to happen after a bullish or upward expansion, right? But there are things like redistribution and reaccumulation where when they happen like in the straight middle of a move. Okay. Is this one of the phases of distribution? Yes. So redistribution is a phase of distribution. And to my people on my team that may be on here right now, you guys will learn this in the future with you guys, but there are actually about 3 to 5 variations of distribution and accumulation that I will teach people that I teach one-on-one specifically. So everybody that's on my team, Andrew, Hav, Giselle, and TJ, I'll be teaching you guys all of these variations. So far, BJ as well, and Jason, look out for these because I'm going to be pulling you guys aside one-on-one to teach you guys what the actual the actual variations in the market. And then anybody else who wants to learn one-on-one with me, text me afterward. Now let's go to an actual live example. Who wants to see a live example? I want to see a live example.
For sure.
So what do you guys see here on the 4-hour time frame?
It's looking like redistribution.
It's looking like distribution, right? Not really redistribution. It just looks like distribution. Correct?
Mm-hmm.
Yeah.
Right. So this looks like distribution. But remember, pretty good question earlier, right? Does the buying climax need to look essentially like the same as the ST? No. Right? In this case, they established this trading range. You see how they established the trading range?
Yep.
But it was broken by the upthrust, came back down, created liquidity, right? And then boomed. Boom back up for the UT, right? For the upthrust. Now, what essentially is going to happen at this point? Right here, we have
Test.
open liquidity, right? Up here, we also have some open liquidity. So what most likely will end up happening is soon we will end up getting a structure break where it will probably push up here and then fall, right? However, we're not looking at this. We're looking at this from this morning. So let's go ahead and look at this from this morning, right? And when was this morning? September 10th. In the morning, that was at 12. That was at 4 in the morning. So right around here. So let's go to the replay. Let's go to right around there. Okay, so let's say this was this morning. And I know that price needs to come back up here. So what am I going to do between the hours of around 7:30 to around 11, which you should keep in mind, again, 7:30 to around 11 is your New York time frame kill zone, which is where time and price correlate so that the dollar gets most volatility and ends up making their moves. What ends up happening here? If I am not sure whether or not price is giving me an entry towards the downside here, what should I be looking at? Hint, it's in my top right, it's in my top left corner.
Can you repeat that?
What should I be looking for? What should I be looking at if price isn't giving me a clear indication of where
A lower time frame.
lower time frames? Perfect. So for me, I personally like using the 3. It's just very clean. To me, I really like using the 3. So at this point, we're looking at this and we're saying, well, cleared liquidity right here. Could go a little bit higher. So let's go ahead and take a look. Okay, didn't give us an entry, never held bullish position. Perfect. Actually, let's rewind it. We passed it a little bit too hard. So right here, I think this is the play, right? Yeah, this right here. So right here, when I saw this, right, what does this look like to you?
Accumulation.
This looks like accumulation to you?
This is distribution.
Distribution.
This looks like
Is that-
distribution, right?
Oh, you're right.
Because
The
one,
curves, yeah.
it has its natural upward curve, right? Which again, like I told you guys, it won't happen every single time, but like I said, right, the from the classroom to the field, right, things change. So this looks a little bit more like, you know, distribution when it happens with this curve. So let's go ahead and put this up. So we have the buying climax, we have the preliminary supply, we have the automatic rally, right? Then we have the upthrust right here. The upthrust right here, right? And then we have the UTAD, upthrust after distribution. What comes after the upthrust after distribution?
The test.
The test.
Test.
And then the test itself needs to be tested, right?
Mhm.
So what is this?
Secondary test, I would say.
We could call it a secondary test, yes?
The last point of supply.
Right, and then the last point of supply comes here. Now I see it hold this trading range, like I see it hold this range from like right here to right here. And what do you think crosses through my mind?
You should sell.
I should sell. Because if it's a true distribution, it will never break this high or this one. So what am I going to do? I'm going to put my short position right around here. I'm going to put my stop loss right around here. Why do you think I'm putting my stop loss there?
Because it shouldn't break that high.
Shouldn't break that high.
If it goes up there, I buy.
Right. If it's true, it will hold that position, right? If it's true, it will hold that position. Now, this is where I'd pull out my fib. The fib is the only thing that I use that you guys may have heard of. Okay? It's the only thing that I use. Because the fib is an actual thing. I love it, right? For me, my kill zone is between the 79 and the 88.6. So right around from the 88.6 to the 79. That's what I end up using, right? That's what I end up using. So keep that in mind, and maybe you could back test it and use it on your trading. I've done classes on this before. maybe tap into those. So what I use these extra lines for is essentially they're my extended take profits. They're my extensions. So the 0 will always be your first TP, right? Your 0, which is right here, will always be your first. Oh no, your 0 is right here. It will always be your first TP. But since you're dealing in lower time frames, you really don't want to do that because it's super small of a TP. It ends up being like what, 15, 20 pips, 15 pips. It's not even worth putting your TP there, right? So you have a 4 pip drawdown entry. Why? Who can tell me why I put my stop loss at 4 pips?
Because it should be a true sale.
Right, because if it's true, it wouldn't break the high. It will retest it, but it will not break it. Since it won't break it, I'm safe to put my stop loss above it, and it won't hit if it's true. Now, if it hits the 88.6 or the 79 as it hit it perfectly right here, that is my entry. Since that becomes my entry, boom, I hit it right there. Now it drops and drops and drops with about 1.5 pips of drawdown. So not only that, but now let's look a little bit higher of a time frame. Let's look at the 20-minute. Where do you think structure will most likely go back to?
That void or that extreme.
Right, extremes, right? Market extremes, perfect. So for me, my last take profit would be around there. Why would it be around there? Well, because first off, previous extremes of the market were right here. So we'll most probably go back to that position, if not lower, right? And if it does go back to that position, perfect. If not, then cool. People who have been in my private calls and people on my team that I personally mentor know the full extent of the market extremes, okay? And they're going to master it. Now, I have a 4 pip drawdown entry, and this is a live trade that I took today, and I posted the profits in the chat. I ended up closing with about 77 or 78 pips in profit, right? But it went for a total of 87, almost 90 pips. Let's see what it would have gone the whole way. Would have gone 93 pips, almost 100 pips, right? Almost 100 pips you would have netted with a 4 pip stop loss off of a lower time frame distribution setting. Now, let's say if you go back to the 4-hour, look at where your entry was. Your entry. Let's hide these drawings. How do you hide drawings? Can you hide drawings? No. Your entry was right here. How many gurus, how many mentors can give you a 4 pip stop loss? Not many. How many mentors can give you an entry right there at the top of the wick? Not many. A lot of people don't because they don't know how to trade. Now, am I saying that every trader doesn't know how to trade? No. Some people have strategies that work for them. That's perfect. Do what works for you. However, this is something that I've proven, I've tested, and I have tried over years of experience. Okay.
So you don't need to necessarily look at higher time frames for
no, you
high
do.
rewards.
You do. You need this higher time frame. You need this. Without you having notified this as distribution, why in the world would you have even been looking for a sell in such a strong uptrend?
Okay.
Right? You need that. So this is exactly what I'm saying about HFX, right? A lot of you guys want to trade HFX, and that's completely fine. But if you don't recognize higher time frame structure, you won't nail the lower time frame structure either. If you really think about it and you use this strategy, it's super easy to trade HFX. It's easy as hell. Why? Because all that you're doing is you're using higher time frame structure to find a lower time frame entry. And this works on every single market, whether you're in stocks, whether you're in binary, whether you're in Forex, whether you're in whatever the hell you're doing, this strategy is going to hold. I'll put it on my whole career. It'll hold. Now, let's go back to the 3-minute. And what ends up happening is you end up getting a almost 0 drawdown entry, right? Nearly 0 drawdown entry. And all of your take profit gets hit, and it ends up going all the way for around 89 pips, right? I closed at 77, but that doesn't really matter. Now, let me ask you guys, and this is the time that you guys can interact with me. What would you do with a 4 pip stop loss.
Bigger
I got a
lot
lot.
size.
Here's another rule that I teach my people. Risk to reward is king. It is God in trading. Because imagine you have a $100 account. What would you do with a 4 pip stop loss? What lot would you place?
Sheesh.
0.10 mini.
0.01.
0.01. Me personally, I popped a
I would have put a
1.0.
10. Yeah, I would put 1.0.
I popped a 1.0. Why? Because I had a 4 pip stop loss.
What the?
That is a $40 loss on a 1.0. That is a $4 loss on a 10.0. People are annotating. Okay, cool. So that is a, you know, that is essentially a $4 loss on a 10.0. That is a $40 loss on a 1.0, and that is a $400 loss on a what is it? Is it a 10.0? Yeah, a 10.0, right? Imagine those lots and you trying to grow a small account.
I
If
think
you're
it's
trying
getting
to grow a
flipped.
small account, that account is getting flipped in one trade. Maybe more. It's getting flipped in one trade. Why? Because you fully understand the concepts of trading. So now you will be rewarded by the market for knowing how the hell it moves. Now, you will know exactly how it moves. Now let's go to Euro JPY, and I'll actually talk about an actual trade that I took here as well. It wasn't as giant, but I did notice it. What does this look like?
Accumulation.
Distribution.
Does this look? This
Oh,
looks
whoa,
like
whoa, whoa.
distribution, right?
Accumulation.
No, this looks
Oh.
like
This is
distribution. Right.
distribution. This is distribution.
Because you have your high, right? You break upward out of your trading range,
Mhm.
and you never break
Yeah.
below, right? You never break below, so you don't have bearish, or sorry, you don't have bullish positions, right? So you have your bearish positions here. Now, what ends up happening is you end up seeing this, right? You end up seeing this right here, and you said, okay, this upthrust, this is the upthrust after distribution. This upthrust after distribution needs to get hit, right? However, this is open liquidity, which needs to be taken. Probably tonight it'll get taken, and I'll put another sell on Euro JPY as soon as it hits this point up here. But that's a completely different lesson. So I see this position going all the way up early this morning. And I said, ooh, perfect. Let me monitor my 3-minute chart. Let me monitor my 3-minute chart and see what happens. What do I see on the 3-minute chart? Nothing much. It looks kind of sloppy. So what do? I look further down my scope. I go to the 1 minute. Now, some people may crucify me for looking on the 1 minute, but I think I hit more pips than them. So look at this. What does this look like? Boom, 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 boom. It breaks bullish structure and ends up making what? Bearish structure.
Bearish structure.
Right? Distribution or bearish structure, right? Now, as soon as I see a breakout of the trading range, which is also known as the sign of weakness or so, right? Or breaking the ice, right? So that a trade can fall through the floor, right? If it falls through the floor, it's a sign of weakness or a break of the ice, right? Breaking the ice. What ends up happening? Right here, we have a pretty nice position. Why? Because we know that if we put our stop loss here, what's going to happen? It's never going to be broken, right? If it's a true upthrust. So what ends up happening? We have a short position. We end up putting it at 50% of this order block. Now, people who are with me know what the hell an order block is, and some other people don't. Tap in with me if you don't know what it is. We have a 3-pip stop loss. Now, we fib it, right? We have our fib in our extensions. Whoops, not what I wanted to do. We have our fib from here to here. Our last extension is right here. But what do we need to have in order for the market to actually, in order for us to properly calculate our take profit? We need to go back.
test.
Right. We need to go back and look at previous market structure. We're on the 1 minute, so that's not very favorable. Let's go on the 20 minute. Well, on the 20 minute, we at least wanted to hit this high, don't we? Sorry, at least this low, right? We at least want to make it hit this low. So what are we going to do? We're going to extend our take profit to at least go back to market structure, which is right around here. Right? If you wanted to be safe, you want to put it a little bit above the high, right around there. So in this case, you end up taking 100 pips for a 30 pip stop loss. And what is your risk to reward? A 1 to 29 risk to reward ratio. 1 to 29 risk to reward ratio. What would you do if your trade had 3 pips of a stop loss?
It's crazy.
Drop a stand up.
Going nuts, bruh.
That's crazy because you also just took Euro USD in the same day. So you ended up taking 89 pips, 90 pips, let's say 90 pips plus 100 pips. That is 190 pips. Let's say you have 190 pips at a 0.10. That is $190. Yes, Elgin. It is being recorded. Yes, sir. And so now that you have this 3.4 pip stop loss, well, you're done for the day, aren't you? With $190, what can you do with $190 every day?
A lot.
A lot. Not only that, but these are only 2 pairs in the market.
Exactly. So this is basically your job. Like,
yeah, this is my job. I literally mark up during Asia and London, and I wake up at 7 in the morning Eastern. I trade 7 in the morning to around 11 in the morning. From there, I'm off. I can spend the day with my grandmother. I can spend the day with my cousins. I can spend the day focusing on my other businesses. I can focus teaching my students, which is what I've been focusing relentlessly on. I've been making a lot of PDFs for you guys, so don't think I've forgotten about you just because I haven't talked to you guys for like 2 hours. I've been preparing this call pretty feverishly. So yeah, essentially this is what you want to be. This is how you want to be trading. Do you ever want to see a 20, a 40, a 50 pip stop loss anytime soon?
No,
That
that
shit's
actually makes me
ridiculous now,
nervous
bro.
when they call trades and they're like, the stop loss is that big.
Now you look back at other people and you start saying, damn, their stop
Insanity,
losses
dude.
are massive. Right? Like, oh, why are you buying there? That's not even in discount. Or why are like you literally are gonna buy at the top? Like, why are you buying at discount? Just from this call, I have given you thousands of dollars of value, and I'm not exaggerating. A lot of people have heard of WWA. I've never taken their course personally, but just from studying their charts, they trade this exact same way. You know how much their full course is? $1,900. $1,900. I'm teaching you this for $235, and you end up getting paid after. So at the end of the day, you are getting, and I didn't teach you every single thing that I know. I taught you a very, very minuscule amount, but it is a very, very golden nugget that I want you guys to take home today, because that is going to help save you from a lot of things. Now, there are a lot of different things and aspects that I haven't covered in this call. I will not cover them in this call. You never understood why millionaires have paid $1,000 courses, because they're not millionaires. Or a lot of them are millionaires. Some of them, like WWA, just because they have a track record. That's really the only reason why I believe them. If not, I'd be like, nah, that's cap. But I've seen a lot of reviews from them, and they're very good. They're very, very good. But I personally have never taken their course, but I know this is exactly how they trade. So it's not just this. There's a lot more other stuff. So I'm going to go ahead and leave it off there. Does anybody have any questions that you guys want to talk about?
Hey, James, can I ask you something?
Yeah.
The reason I've never studied Wyckoff is because a lot of people say it's like super difficult to learn it. Is it very difficult to learn the whole thing?
No. No, not at all.
Cool.
Yeah, no, it's not. Who was that, by the way?
Enrique, Kike.
Oh, nice. Okay. Yeah, no, it's not. It's not hard. You have to know when to use it, and you have to know when to use other strategies. There is something that I've considered a hierarchy of price. And this hierarchy of price is essentially is something where you learn when to use Wyckoff, when to use certain other things, when to see one thing or the other. Essentially, is what you want to be doing. Yeah. Any other questions? Also, did that answer your question, Enrique?
Yes, it does. Thank you.
All right. What about everybody else? Does anybody else have a question?
Not really.
All right, T. By the way, I still need to get back to you on your one-on-one.
Yeah, man.
What about?
This is nice. This is nice.
Well, I hope this helped you, bro. What about everybody else?
And this was really helpful. I'm definitely gonna tap in with you.
All right,
Yeah,
great.
I definitely need to get in with you. I texted you earlier today on the Discord, and I definitely need this guidance right here. I appreciate it.
All right, bro. No problem.
Thanks.
No problem. Anybody else who would like to tap in with me? Text me after. I am Hex. Let me see if I popped it up.
Is Telegram better for you or Discord?
Yeah.
For me, Discord and Telegram both work. Text me on both, whichever one you really want. For me, I'm gonna drop in my my thing right here. It's gonna be my this is my my Discord, and then whoever wants my Telegram, just DM me and ask me for my Telegram. If that's more convenient for you, that's fine as well. The recording is going here, Snug. It is going into, first off, it's going to my people, and then if Giselle allows me to drop it in the traders chat, I'll drop it back into the traders chat. But usually it's for members only. Well, for people that are under me directly only. However, if Giselle allows me to, I will drop it there. If you might want to, beg her. But yeah. Apart from that, thank you. I appreciate it. You have some questions, no problem. Go ahead. Go ahead. You can ask me anything you would like. If you are a non-member, please text me. This is essentially what the type of education that you will be receiving with me and everybody else who is from Empire. Thank you guys for tapping in. I actually have an announcement to make later tonight. Maybe some of you guys have caught on by now, but I've been asked to come on to IM as a potential educator, and I've gotten in touch with a whole lot of amazing people, and I'm looking to change the brand of the company very, very soon. So thank you guys so much for coming.
Claps to you. That's big. Oh my gosh.
Yeah, I'm gonna change everything.
I appreciate you guys. You guys have been my family, and you guys have been the ones that brought Empire.